Chapter 12, Strategic Investment Decisions. Well, this chapter is very similar to what you'll learn in your Principles of Finance class. In this chapter, you will apply 4 metrics in capital budgeting specifically to evaluate investment decisions. And the concepts are, the first metric used is net present value, NPV. It's a measure used to assess the appropriateness of capital expenditure. It takes into account of all present and future cash flows, both inflows and outflows, associated with a certain project, and discount the cash flows back to current time. If the net present value is positive, then the project is profitable in today's value and we accept it. If the NPV is negative, then we reject this project because it's unprofitable based on our required rate of return. When we choose between projects that are positive in NPV, we choose the highest NPV project. It is the most preferred measure for evaluating appropriateness of capital expenditures. One assumption is that the firm has the ability to reinvest cash flows at the rate of return equivalent to cost of capital and similar to the idea of compound interest. So the NPV measure does have assumptions that need to be held true. The second most popular metric is the internal rate of return. It's another measure with the same purpose as NPV. IRR is the discount rate that makes NPV equal to 0. Its value indicates the rate of return that is offered by the investment itself. We accept the project whose IRR is larger than your required minimum rate of return. We choose the highest IRR project if you have to choose only one. The assumptions within IRR are very similar to NPV, but there are a few more disadvantages like possibility of multiple IRRs when we do the calculations and inability to distinguish between investments and borrowing. Payback period. The number of periods, usually in years, after which you will recover the cash outflow from your initial investment. It's extremely simple to apply, but it has many disadvantages, such as the negligence of time value of money and whatever happens after the payback period. The fourth and last metric is accounting rate of return. It equals to incremental net income of the investment divided by initial net investment. Note, out of all 4 evaluation measures, this one is the only one that is not cash-based. This is also the least recommended method because it ignores time value of money and it's not cash. When we make long-term capital budgeting decisions, we really want to look at the cash values from year to year, because $1 million given to you next year compared to $1 million given to you 20 years later can have a huge difference in value as of today's value. And that's why we want to look at cash flow and we want to be able to discount them. That's why the net present value and internal rate of return are the 2 most preferred methods in capital budgeting.